Our next guest says that retirement funds are more likely to use options in the future. Joining me now is Ken Mungan, and he's with the Milliman company, and he's in the risk management area there, so it's terrific to talk to you today, and I know you're going to be speaking later. And what are some highlights of your speech?
Well, thank you. I'm glad to be here. I think the key points from my talk are that life insurance companies are increasingly suppliers of retirement savings products and retirement income products, and we find that all of those products include options in one form or another. In index annuities, those products include a call option. Variable annuities include put options. And as a result of the global financial crisis, we're seeing increased demand for exchange-traded options over the-counter options. And also just individual investors are much more interested in retirement savings products that include the protection features that are commonly offered by insurance companies.
What's the growth been like over the past couple of years in this area?
Oh, the growth has been very significant. Everyone's familiar with the demographic trend of the baby boomers transitioning into retirement, and so they've been accumulating their assets, and now they're going to be drawing down those assets over time. And as we've learned from the market, from the global financial crisis, a disruption in the market can really destroy people's retirement plans. And so that fundamental demographic force is driving tremendous growth in this sector, and it's really pushing people to explore products that include the protection features that can only be created through the use of options.
Fair to say there might be some concern out there. Some people say when you have something so sophisticated, they're concerned about their retirement funds and what could potentially happen. So is there any downside risk out there for these people?
They need a financial intermediary like a life insurance company or a fund manager to package a strategy for them so that they get exposure to the underlying investments in stocks and bonds and then the protection features that can be offered through an options-based strategy.
Can you give us some examples of how options have helped people with retirement funds, these big funds coming, and pensions, and how maybe people benefited from working out all the volatility issues that can play into those funds?
Sure. Well, the typical person saving for retirement, had they had, for example, a variable annuity with a guaranteed minimum withdrawal benefit feature, that's the most common product in the life insurance sector, they really simply wouldn't have to worry about their getting guaranteed lifetime income during retirement. Even through the depths of the financial crisis, they knew that their income was protected. And from the institutional investor's perspective, life insurance companies, through the use of their hedging strategies, we find that they have generated over $40 billion of gains at the worst point in the crisis through the use of hedging strategies.
That's amazing.
Yeah, it was really wonderful. And if you think about the crisis that would have come had the insurance industry not deployed hedging strategies, it would have just been awful.
Well, that was my next question. What happens when you don't hedge?
Oh, then when you have a financial crisis, if you don't hedge, you have a solvency crisis, and that has to be avoided at all costs.
Thank you very much. Well, we've been speaking with Ken Mungan of Milliman. Great to talk to you today.
Thanks a lot.